Hello there. We're interested in the topic today of payroll taxes. To start the discussion, we're going to think about income taxes which are withheld from paychecks. And keep in mind that almost all of us have a portion of our own income tax that the company is required by law to take out of our paycheck. This is the primary reason that we receive tax refunds when we file a tax return. There are other reasons like what we call refundable credits. Didn't pay anything but still get a tax refund. But the biggest reason that people get refunds is because they've paid too much in the way of tax withholdings. Well, in addition to withholding your taxes, a company is also required to hold Social Security or withhold Social Security and Medicare. So if you work for an employer, Social Security is withheld at 6.2% of income up to $117,000. So some people say that's regressive. Wow, rich people don't have to pay Social Security tax above $117,000. This is a true statement. However, the idea is that wealthy people can provide for their own retirement. So a very wealthy person, a millionaire, gets the same Social Security that any of us do, up to $117,000. And then after that, doesn't matter how many millions they make, they still can't get more Social Security. Medicare, on the other hand, is our health plan for elderly people. And here, you pay 1.45% in withholdings. The company must take this out of your check. And there's no cap. So if you're rich, you just pay more on this. The act that lets the government take this amount out of checks is called FICA, which stands for Federal Insurance Corporation Act. Sometimes you'll hear Social Security referred to as FICA. Sometimes you'll hear Medicare referred to as FICA. I want to point out, Social Security is the retirement, Medicare is the health, and FICA is just the act that lets the federal government take this out of your paychecks. So both of them are FICA. The employers must match these. So even when the 6.2 plus the 1.45, which if you do your math adds up to 7.65, even when that's taken out of your check, the company has to take 7.65 out of their own funds and pay another portion of your retirement and your Medicare. Let's talk for a minute about tips. So if after this class you start doing tax work and you run into somebody who gets money from tips, the tips are taxable. So just because the person doesn't receive a paycheck doesn't mean that they don't owe money on the tips. So what an employee is expected to do is file Form 4070 and report their tips by the 10th of the next month. Well, sometimes the government has a hard time believing that employees do this. So for large restaurants, they compare gross receipts that the restaurant reports on what's called a Form 1120. That's a corporate tax form. And they match all the tips that all the employees report to those gross receipts, and 8% of them must show up. So if all of the individual servers report, let's say 5 or 6% combined, that's not enough. There's no penalty for that. But what happens is the employer will have to allocate tips to all the employees to get that number up to 8%. Payroll taxes collected by a company or owed by a company must be reported, and they're typically reported quarterly on a federal IRS form called Form 941. For businesses to pay taxes, which is a different thing than filing, there are a few different schedules that employers have to look at and see which one they meet. So if an employer doesn't do anything else, the employer is assumed to be a monthly filer. And if they're a monthly filer, they have to pay taxes monthly, and they owe this if the total payroll taxes for a look-back period are $50,000 or less. And we'll talk at the bottom of the slide about what the lookout period is, or the look-back period. So bigger employers are called semi-weekly filers. And semi-weekly is not intuitive, but it is the right term. This implies that anytime a payroll ends on a Wednesday, Thursday, or Friday, the firm has a half a week to pay. They have to pay by next Wednesday. Anytime the payroll ends on Saturday, Sunday, Monday, or Tuesday, they have a half week to pay. They have to pay by Friday. That's where the term semi-weekly comes from. It doesn't necessarily mean 2 pay periods a week. It really means the company can't sit on the money longer than half a week. The look-back period is determined by IRS each year. And if you look at what happened for 2014, so that's the year we're in. The IRS hasn't set the look-back period for 2015 yet, but when employers were trying to figure out if they were semi-weekly or monthly employers at the beginning of 2014, they had to look at the 4 quarters that went from July 2012, you see that right here, to June 2013. And typically, this is the period, 3rd quarter of one year to 2nd quarter of the next, where the IRS makes you try to figure out if you had total payroll taxes of $50,000 or more during that period. Please keep in mind, we're talking about taxes here, not wages. So the total taxes have to be $50,000. Now there's a couple more very small nuances to consider. If the total payroll liability is less than $2,500, then the business doesn't have to pay monthly or semi-weekly. They just wait until they file the 941 and then pay the payroll taxes. However, if the payroll liability is ever over $100,000, then the payment is due on the next banking day. So keep in mind, even if you're a semi-weekly filer and you have a payroll liability that goes over $100,000, you have to pay on the next banking day. And this is really getting at the idea that the IRS doesn't want to leave you a great amount of time to get behind on your taxes. So here are some things about deposit penalties. So if a company pays 1 to 5 days late, they're subject to a 2% penalty of the unpaid deposit. Not the total deposit, unless they didn't pay anything, but rather just the portion they didn't pay. If they're 6 to 15 days late, they owe 5% in a deposit penalty. If they're greater than 15 days late, or if they didn't do an electronic deposit, if, for example, they wrote a check to somebody, but they were supposed to pay by electronic deposit, or if they paid the IRS directly, which is not allowed, or they didn't pay a bank that they had told IRS they were going to pay, they paid some other bank. Because keep in mind, payroll deposits have to be paid to a bank that the IRS will accept them from, which is most banks, and that's the only way they can get paid. So if any of these 3 conditions hold, then there's a 10% penalty on the deposit. And if the IRS has sent a notice and more than 10 days have gone by and the amount still hasn't been paid, then the penalty increases from 10 in most cases up to 15%. Here are some other payroll type taxes. First, this was one of the things that confounded me when I started my individual income tax class back in the 80s. When I first looked at this, I said, good Lord, the self-employed people are right, man. They're eaten alive. They pay taxes like nobody else. Because there's a self-employment tax of 15.3%. So a small business where the owner employs themselves not only pays federal income tax, just like any other taxpayer, but also self-employment tax. However, keep in mind, this really isn't a penalty. This considers the fact that if you employ yourself, there's nobody else that's collecting Social Security and Medicare for you. Therefore, we have your portion as an employee of Social Security, your portion as an employer of Social Security, your portion as an employee for Medicare, the company's portion as your employer for Medicare, and because this is all you're working for yourself, you have to pay an additional 15.3% of your net pay, of your gross pay, on top of any business tax that you owe, including Schedule C type business taxes. Unemployment tax. These only apply to businesses. Individuals don't have to pay unemployment taxes to the federal government. And in Virginia, we don't have to pay unemployment taxes to the state government. Some states require you to pay as an individual. For example, California has been one of those. Some states don't have an unemployment tax program. I think North Dakota is one of those. But in Virginia and all the surrounding states, both the state and the federal government have unemployment programs, and that's important. Look at why. The federal program would require 6% unemployment tax up to $7,000 per worker. So they say that the average American worker makes about $40,000 a year. If that person stays at the same job, they don't pay 6%. The company doesn't pay 6% for them on all $40,000. They only pay 6% up to $7,000. So this is one way taxes encourage a company to keep its employees. If they have a whole bunch of employees, none of whom have earned very much money, they have to pay 6% for all of them. If the state has an unemployment tax, which Virginia does, then there can be, and indeed there almost always is, a 5.4% credit against the federal tax. So in Virginia, a Virginia business will pay 0.6%, which is less than 1%, to the federal government, and then they'll pay some amount to the state government based on state rules. The only thing I really want to say about the state here, and I'm just making this casual observation in case you care, that in the state there's also a percentage charged, but it is charged up to $8,000 per worker. Household taxes. I mentioned this in the overview video. So if you have a household employee, like a nanny, then if that person's paid more than $1,900, or if you withheld federal income tax for the person's check, or if you have a butler and a nanny and maybe a gardener, if the total wages are $1,000 to all of them, then you have to do Schedule H, and that's what this means. And Schedule H has some other taxes, in some cases that you withhold from checks or that you pay from your own funds. We wrap up the payroll tax discussion with a list of forms. So Form W-2 is one probably everyone's seen. An employer gives this to employees, and it lists wages, withholdings, etc. The employee will produce their tax return with this. W-3 has nothing to do with employees directly. Rather, the employer sends this to the IRS, and it has all wages from all employees. W-4 is something that an employer asks an employee to complete at the beginning of their employment, and it lists how many withholdings the employee is claiming. A W-9 is something that an employer has to receive from an employee, and this provides evidence of the right to work. So there's a number of things that show up on the form. Look in the chapter to see what they are, but basically the purpose of the form is for the employer to make sure that the employee has the right to work and that the employer has proof of this in case they're audited by IRS. Finally, a Form 1040-EZ, if you hear that number 1040, you're not mistaken. This is an estimated tax payment that an individual is going to make, and for a person that doesn't have the company withhold everything, or for some reason doesn't have the company withhold anything, self-employed people might be in this boat, they file quarterly 1040 ESs and pay taxes with them, and then those taxes are compared, the tax they paid in is compared to how much they owe to see if they have a refund or indeed if they owe some more tax. Well, this is payroll tax. Give me a call if you have any questions, and I wish you luck.